Okay, welcome to the deep dive. Today we are taking a deep dive into QuickBooks, specifically looking at insights from the Protea Academy QuickBooks video series. Our goal here is really to pull out the key practical nuggets for you.
That sounds great. Yeah, these sources seem to offer a pretty solid tour, right? From getting started all the way to like advanced reporting. We're trying to understand not just what it does, but maybe why some features are set up the way they are, according to these videos.
Perfect. So beginning first, the initial company setup. The videos mention asking about, income sources, payment
Right, how
methods.
long you've been in business type industry,
Yeah.
that kind of thing. It's laying the groundwork. But the absolute foundation they highlight, that's the chart of accounts.
The chart of accounts. They call it the sort of fundamental list for tracking everything.
Exactly. And the sources really emphasize getting that right from the start. It's the backbone, truly, because every single transaction, every dollar in or out, it gets assigned an account from that chart.
So that dictates all the categorization, which impacts the reports later on. Makes sense.
Totally. Garbage in, garbage out, right?
Yeah.
If the chart's messy, the reports won't be much help.
Okay, got it. So let's follow the money. Money in first. Customer profiles. The sources talk about adding contact info, address.
And critically, terms and preferred payment methods. Setting those terms, that's not just, informational. It actually drives how you track receivables
Receivables, right. What customers owe you. And that links to generating customer invoices.
correctly. You create the invoice, customize it maybe, add your products or services, set those crucial terms and due dates. The videos mentioned you can schedule recurring ones, which is handy, or just email it, send a link.
And that invoice creation, that's the first step in managing your accounts receivable, the money owed to you.
Precisely. Then receiving payment closes that loop. You apply it against the open invoice.
Right.
But if it's a sale paid right away, cash, check, card on the spot, the sources say use a sales receipt.
Okay, what's the key difference there? Invoice versus sales receipt in terms of workflow or reporting?
Well, the main thing is an invoice creates that accounts receivable balance. It shows someone owes you money in your balance sheet. A sales receipt bypasses AR. Payment's immediate. Hits cash or bank, records the sale. One's credit, one's cash, basically.
Got it. And estimates are just sort of quotes before an invoice.
Yeah, well, it's like a starting point. You can convert them later. And for seeing where the money comes from, they point to sales reports, sales by customer, sales by product.
Okay, let's flip it. Money out. Expenses and bills. First step, adding vendor profiles. Similar idea. Name, contact.
And again, terms are important. And they draw a really clear line between an expense and a bill.
Right. Expenses paid right away, like using a company card.
Exactly.
Right.
You record how it was paid, which bank account or credit card, and categorize it using your chart of accounts. Done. A bill, though, that's something you owe, but you'll pay later.
So entering a bill involves the vendor, the terms, because that creates an accounts payable balance, money you owe.
Yes, exactly. It becomes a liability. And those terms are vital because they feed your AP aging reports.
Ah. So just like AR aging shows who owes you and when, AP aging shows who you owe and when it's due, critical for cash flow management.
Absolutely critical. The videos cover that, plus vendor credits for returns, and then the whole process of actually paying bills, seeing what's due, selecting bills, recording the payment.
It's interesting how these basic entries, invoices, receipts, expenses, bills, they all feed into the main financial statements, right? The P&L and balance sheet.
That's the whole point, really. Every entry builds those reports. The sources also touch on products, services, inventory. Key types are service, non-inventory, and inventory. Why is the distinction important, especially for inventory?
Okay, inventory items. QuickBooks tracks the quantity, you said, but also the cost.
Yes, the cost. So when you kill one, QuickBooks automatically calculates the cost of goods sold, COGS, and puts it on your P&L. That directly impacts your profit calculation. That doesn't happen for non-inventory or service items in the same automated way.
And it uses FIFO for that cost calculation you mentioned.
Behind the scenes, yeah. The source material knows it uses FIFO, even if maybe an item list shows an average cost sometimes. Small detail, but it matters for accuracy. You bring inventory in typically through bills using the item details section.
Okay. Moving on to banking. Linking bank accounts seems heavily recommended in the sources.
Definitely. It automates getting the transactions in, saves tons of time, reduces errors compared to manual upload, which is also an option via CSV. Once transactions are downloaded, you categorize them, match them to things already in QuickBooks, like bill payments, record transfers.
The goal being to get everything processed so your QuickBooks bank balance matches the real bank balance.
Pretty much. And they mention bank rules to help automate the categorizing, but with a caution, don't make them too vague or you might miscategorize things.
And the final check on all that is the bank reconciliation, matching QuickBooks to the bank statement.
Vital. The sources stress this. It confirms your data integrity. If your bank rec is clean, you can trust your numbers, especially cash.
Right. And trust leads us to the reports. Beyond P&L and balance sheet, we mentioned the AR and AP aging reports. What else is key?
The statement of cash flow. The sources actually call this maybe the most important report for managing day-to-day operations. It shows the actual movement of cash, where it came from, where it went, cuts through the accrual stuff to show the cash reality.
And you can customize most reports, dates, filters, cash versus accrual.
Yeah, customization's huge. Filtering by customer, vendor, class, location, getting the view you need. They also mention using classes and locations for segment reporting, like profit and loss by department or site.
Okay, so we've gone from setup through money in and out, inventory, banking, and into reporting. This dive, based on the Protea Academy stuff, it really shows how connected everything in QuickBooks is. An entry isn't isolated.
Not at all. It feeds the whole system. Entering bill terms correctly impacts AP aging and cash planning. Setting up inventory right impacts key OGS and P&L. It's about turning that raw data into information you can actually use to make decisions.
Absolutely. So for you listening, it means understanding every step matters for that big financial picture. And here's a final thought, drawing from these sources. If you focused on improving just one data entry habit, maybe always getting vendor terms perfect, or consistently using bank rules for certain expenses, how might that single change give you a surprising, maybe actionable insight next time you look at your AP aging or your cash flow? Something to think about.